On Wednesday, the 12th of March, we've seen that the CPI print came in below markets expectations. That allowed equity markets to find a little bit of relief on the initial print, although tariff worries quickly weighed on equity markets. But the basic idea is that the lower inflation is in the US, the more likely that the US is going to be able to cut interest rates. So that's dollar weakness, equity upside is the general rule of thumb. There's a lot of moving parts at the moment, so that doesn't always work out that way. However, what I want to point out, something you may not realize, is the PPI print that comes the day after the CPI print. Elements of this PPI print are incorporated into the PCE inflation print. That's the Fed's preferred measure of inflation. So you might have a PPI print that's really high, and you think, oh, that's positive for the dollar, and the dollar sells off because people take the components, economists, from that PPI, factor it into the PCE, and then project what the PCE is. So the way markets react is what the projected PCE print is from the PPI, rather than from just what the headline is. It's a little small point, but it's something to be aware of, because you could get caught out on a hot or a weak PPI print. You're expecting one reaction, the dollar does the opposite. It's often because of that PCE impact that you see going on. Just a little tip that I wanted to pass on.